So last class, we went over discounted bonds payable using the effective interest method. So starting today's class, you're going to do a practice problem for a discounted bonds payable. And I want you to read through it and just remember that we have two different interest rates that we're looking at. We have the stated interest rate, which is the interest rate that these bonds are paying interest based on annually. And then we have the market interest rate, which is what similar bonds would be paying. Because there's two different interest rates, we're going to be calculating interest expense that's different than interest paid out. And we're going to be amortizing the bonds, the bond discount, based on that difference that we're calculating. So remember that we're using an amortization table down here. The dates are already provided for you, but I want you to think about why these specific dates are used. And I want you to fill out the first three dates. So don't worry about that last date. It's just there to show you what happens at the very end at the maturity date. But fill out the first three dates that are in the table and then address the questions A through E. And of course,
Is this problem somewhere?
I have a handout for it, but it's a little bit confusing how it is in the handout. So it's best to just
Okay,
without the handout. Sorry.
no problem. Thank you.
Okay, I'm going to pause now. Okay, I wanted you to practice it just before we got into it so that you kind of can identify where you're struggling before you get into the homework. So, sorry if it was overwhelming. It wasn't my intention. But bonds payable are definitely a beast and it's a harder chapter, and I want you to be prepared for it. So, Valley Company issued 5-year, so that's the term, 6% bonds. It's the stated interest rate with $100,000 face value. So, what do we know about the face value of the bonds? This is the amount that they have to pay back at
the end.
At the maturity date.
Term.
Maturity date.
It's not necessarily what we receive when we issue the bonds. The bonds are dated January 1st, 2012. So that's the issue date. And call for semi-annual interest payments on July 1st and January 1st. Assume Valley issued the bonds when the market interest rate was 7%. So we know it's a discounted bond because the stated interest rate is 6%. So these bonds will be paying out 6% interest when similar bonds were paying out 7% interest. We also know it's a discounted bond because the issue price is less than face value. So they issued the bonds for $95,842. They had to discount those bonds in order to issue them. So before we get started, let's calculate the amount that our discount is. So we're going to take our face value of the bonds, which is 100,000. And we're going to subtract or compare that to the issue price. The issue price of these bonds was $95,842. We're kind of netting those two amounts to get the discount. And the discount was how much for these bonds?
6%?
Nope. 6%
4,000.
interest.
4,158.
Yeah, 4,158. So the 6% is the amount of interest that's paid annually. The discount is the difference between face value, what we have to pay back at maturity, and the issue price, what we receive when we issue the bonds.
Oh, okay.
Lots of terms in this chapter that you guys do not use on a daily basis. So on January 1st, 2012, we're going to start with this entry. What do we debit when we issue the bonds?
Cash and discounts on bonds payable.
Yes, so we're going to debit cash, increasing cash. How much cash do we receive?
95,842.
95,842 equal to the issue price. We're going to leave a space for now, and we're going to credit which account?
Bonds payable.
Bonds payable. So the liability account, we now have bonds outstanding. Going to increase bonds payable for how much? What amount is always recorded in our bonds payable?
The face value.
Face value.
100,000.
Exactly, 100,000 face value. So regardless of how we issue the bonds, we're always going to credit bonds payable for face value. Do we balance?
Yes. No. We need to the discount
Yep, we need to
for
include
the
that discount on bonds payable.
4,000.
The difference that we need is a debit, right? 4,158. And we're going to debit that contra liability account discount on bonds payable. We know at maturity, this account will be 0. It's slowly going to be reduced at every interest payment date. So once we have that journal entry, we can fill out that first date, which is always our issue date. So we're looking at our amortization table. And do we pay any interest when we issue the bonds?
No.
No. Do we incur any interest expense when we issue the bonds?
No.
Nope. The debt hasn't been outstanding yet. So we have no discount amortization this period. The discount balance is the initial difference between face value and the issue price. So 4,158. And the carrying value is always equal to the issue price. That initial carrying value is always equal to the issue price. 95,842. For discounted bonds, when you add up column D and E in the same row, it always equals the issue price. I'm sorry, always equals face value. When you add up these two, it's just a little check. It's always going to equal face value. Questions on the issue date?
I had a quick question.
Yes.
Could you quickly just explain again why there's 0 for the interest payment and expense and amortization?
Yeah. On the issue date, your bonds haven't been outstanding, so you don't owe interest yet.
Oh, okay.
You're going to owe interest and pay the first interest date 6 months after. because these bonds pay out interest every 6 months.
Okay. I see. Thank you.
So your first date, your issue date will always be 3 zeros for interest paid, interest expensed, and then discount amortization. Six months go by, and now we have our first semi-annual interest payment date, July 1st, 2012. Right? So we've had these bonds outstanding from January 1st until July 1st. So 6 months worth of interest is owed for. And to calculate our interest payment, which is always going to be the same amount, we're going to take the face value of the bonds, which is 100,000, times the stated interest rate, 6%, so 0.06, times 1/2, because we're paying half of that annual interest rate every 6 months. So what amount of interest will we be paying out to our bondholders?
$3,000.
$3,000. So it's a pretty round number. It's always going to be a pretty number for you. Okay, now for the interest expense in column B, it's not going to be such a pretty number. Interest expense is based on the prevailing market interest rate when we issued those bonds. So the calculation is our preceding bond carrying value times our market interest rate times 1/2, because again, the bonds are paying every 6 months in interest. These bonds paid annually, you know that you would just drop off the 1/2 part. So for July 1st, 2012, our first semi-annual interest payment date, the preceding bond carrying value is always equal to our issue price, $95,842. So we just go up one row and take that carrying value. The market interest rate is 7%, so times 0.07 times 1/2. And we're going to round it to the nearest whole dollar.
3,000.
3,354.
Yeah, 3,354 is the amount of interest expense that we're going to record on this interest payment date. The discount amortization is the difference between the amount of interest that we're going to pay and the amount of interest that we're going to expense. So the difference, the absolute value, if you will, because it needs to be a positive number, between interest paid and interest expense, 354. Our discount balance is going to be reduced for the amount of amortization that we take. Because slowly but surely this discount balance is going to creep towards 0, because at maturity, there won't be any balance. So what is our new discount balance?
3,000.
3,804.
04.
Over time, because these are discounted bonds, the carrying value of these bonds is slowly going to increase towards face value. So 95,842 plus the 354 gives us our new carrying value, 96,
196.
196.
Sorry, can you show how you got the discount balance?
The discount balance is 4,158, which was your initial discount balance for the preceding balance, minus your discount amortization for the period.
Okay.
Professor, wait, what does it mean, BBE?
Beginning balance of E. So here's E.
Beginning balance of,
Yeah, it's really the preceding balance of E. So it's just the balance before.
Professor Wade, I got lost on the discount amortization.
The discount amortization is the difference between the amount of interest that you pay and the amount of interest that you expense.
Okay. And then to get balance again, you said,
Take your discount balance, the prior discount balance or preceding discount balance, 4,158, and you subtract out your discount amortization for the period. So 4,158 minus the 354.
okay, thank you.
For part B, it's asking you what is the entry on July 1st, 2012 to record the interest payment and amortization. So we're going to have one debit, skip a space, and write a credit. And on July 1st, 2012, we're paying out interest. So we're incurring interest expense. So we're going to debit interest expense. Increasing interest expense for what amount?
3354.
3,354, which comes from column B. We're going to credit which account?
Cash.
Cash, because we're paying out interest. How much interest are we paying out?
3,000.
3,000 from column A. And we need more debits or credits to balance.
Credits.
We need
Credits.
more credit.
more credits for
And
354.
354 is the amount, correct? To balance, this is coming from column C, which is the amount of amortization. And the credit is to discount on
bonds.
bonds payable. Because we're reducing our discount account each interest payment period. So notice when we subtracted there, that's what we're doing in the T account too. For the next semi-annual interest payment date, they pay interest on July 1st and January 1st. For the January 1st payment, when do you incur the interest? During 2012 or during 2013 when you actually pay it?
12.
2012. So the journal entry for January 1st will look slightly different. The calculations will be the same though. So how much interest will be paid on January 1st, 2013?
3,000.
3,000, because we know that that's the amount of interest that will be paid every 6 months for the life of these bonds. For the interest that we're going to expense, we need to calculate it, right? So this is our January 1st, 2013 payment, our second semi-annual payment. What is the preceding bond carrying value?
96, 196.
96, 196. Yep, from the table. So slightly higher than we had before because we've already amortized the bonds for one period. The market interest rate does not change. It's still at 7% times 1/2. So on this second semi-annual interest payment date, what amount is our interest expense?
3,367.
3,367, correct. So slightly higher than the prior period, which you would be expecting because your carrying value is increasing over time. The amount that we're going to amortize the discount will increase slightly as well. The difference between 3,000 and 3,367 is $367. Our discount balance is again going to be reduced. 3,804 minus 367 gives us a new discount balance of 3,437. Our bond carrying value is going to increase towards face value. So 96, 196 plus 367, the amount we amortize those bonds. 96, 563 is our new bond carrying value.
Wait, how did you get that? Can you read that one more time?
For carrying value,
Yeah.
96, 196 is our preceding bond carrying value,
Mm-hmm.
plus the amount of amortization this period, which is 367.
Okay. Thank you.
You're welcome. For Part C, it says, what is the entry on December 31st, 2012 to record the accrual of interest? So that table is great and all, but we need to make sure that our December 31st bonds payable that's represented in our liability section of our balance sheet is up to date and accurate. We also need to make sure that all interest expense that's been incurred during the year is recorded. We had those bonds outstanding for the entire year, but as of right now, we only have 6 months worth of interest recorded. So we need to accrue for the second 6 months worth of interest. Our journal entry will be similar to what we did on July 1st, but slightly different. We're still going to debit interest expense because we need to record interest expense. Increasing interest expense for 3,367 from column B. We are still going to credit discount on bonds payable, reducing the discount for the amount of amortization, 367 from column C. But our credit Our last credit is not going to be to cash because we're not paying out cash until tomorrow on January 1st. So we need to
Interest payable.
accrue for it, and we're going to credit interest payable. Increasing the liability because we owe for $3,000 worth of interest that we're going to pay out on January 1st. All of that interest related to 2012, that's why all of it's accrued for at the end of 2012. The big reason why we need this journal entry is for Part D. Show how the bonds would be represented on the December 31st, 2012 balance sheet. So this is obviously the partial balance sheet. December 31st, 2012. And we have in our liabilities section, bonds payable. Bonds payable is 100,000. What we have in the account. The discount on bonds payable is a contra liability account. So we subtract the discount. And this is the discount balance as of December 31st. $3,437. So what we would show is a balance to the account of 100,000 minus 3,437. Bonds payable would be equal to, just put it here. The carrying value, 96,563. If we did not record that last journal entry, we would have understated our liabilities because we would have only showed a bond carrying value of 96,196. For Part E,
Professor,
yes.
oh, I have a question about the dates because the balance sheet, it says it's on December 31, 2012, but we recorded on January 1st, 2013. Even
Yes.
that, we need to do that's
So
what I was confused on the date.
your amortization table shows the date that you pay interest. Your balance sheet is your year end or your period end. So we record the interest as of our balance sheet date because we incurred interest from July 2nd until December 31st. We won't be paying interest until January 1st. Our balance sheet is showing as of year end, which is as of December 31st. Since we recorded this accrual, our liabilities are up to date. Our discount on bonds payable is correct. And it's recorded at 3,437. And our bonds payable, the carrying value is at 96,563 as of December 31st. What you would see on January 1st when we actually paid it would just be a debit to interest payable for 3,000 and a credit to cash for 3,000.
Okay, thank you. Is what we did the payment on last month, right? But we recorded
we
in January.
Yeah,
Okay.
we actually pay it. For
Okay,
Part E, what is the entry on January 1st, 2017, which is the maturity date? To record the maturity
So
of the
bonds payable is 100,000 debit.
So yeah, wait 1 second. When the bonds mature, we're gonna debit bonds payable. Reducing bonds payable for $100,000 equal to face value, because now we're paying back the amount that we borrowed. And we're going to credit what? Cash,
Cash.
paying back face value, because that's what's owed at maturity.
Wouldn't there be an interest payment too, though?
Yeah, but it's not asking
But
for
we're
that.
not recording it.
You
Okay.
would have to go through the whole process of doing the rest of the table to record it. So we're not going to do that.
Okay.
But yes, there would be. So 1/1/2017 maturity date. It looks identical to what happens when with a bond that is issued at par, which it should. Okay. We're going to take a 10-minute break. Questions before that?
No.
Okay. Come back by 11:25. We'll take a 10-minute break, go over the premium, and then you'll do another practice problem. Okay, so once you've gone over bonds issued at a discount, bonds issued at a premium is not much different. The amortization schedule looks similar. There's only one tiny difference in what we're doing in the amortization schedule, which is, if you notice the bond carrying value, instead of adding the amount of amortization that we're taking for that premium, we're subtracting it, because when you issue bonds at a premium, the issue price is higher than face value. We're going to receive more cash than we have to pay back at maturity, because these bonds are paying a higher interest rate than the prevailing market interest rate. So we're going to look at this example. They issue the bonds on June 30th, 2018. Face value of the bonds is $600,000. Stated interest rate is 10%. Interest is paid on June 30th and December 31st. And the maturity date is June 30th, 2033. So 15 years is the term. Which we will need. The market interest rate at the date of issuance is 9%. So similar bonds are paying less interest than what we're offering. So these bonds are going to be issued at a premium. We will have to calculate the premium using that formula again. So I'm going to write it up at the top this time, if that's okay. In Excel, we're going to use the present value calculation. We're going to go equals negative PV present value, open parentheses. Since these bonds pay interest semi-annually, twice per year, the first number is going to be 1/2 the market interest rate. So the market interest rate at the date of issuance was 9%. So 1/2 of that is going to be 0.045, comma. The second number that we're going to include is the number of payments. We're going to take our term and multiply that times 2 because these bonds pay interest twice per year. If these bonds only paid interest once per year, then you're going to put only the term here. So 30 is going to be the number of payments, comma. The third number is our semi-annual interest payment. So we're going to do the calculation below. Face value of the bonds that were issued was $600,000 times the stated interest rate, which was 10% per year, times 1/2 because these bonds pay interest twice per year. So half in June, half in December. What amount of interest is going to be paid out twice per year? Thank you. 30,000. After the comma, put 30,000. Do not put a comma. Remember, for the Excel formula, it's just the number 30,000. The last number that we're going to include is going to be equal to face value, which is 600,000. Again, no comma. And then close parentheses, enter. So thank you, Christian, but we're going to do it in Excel together. So I'm going to pull up Excel right now. And I will just delete that really fast. So equals negative PV and then 0.045, comma, 30, comma, 30,000, comma, 600,000 is the face value. So in my mind, I know that this number has to be greater than 600,000. It shouldn't be extremely higher than 600,000, but it's going to be a weird number that is higher than 600,000. So 648,867 is our issue price. And I'm going to go back to the table. Okay. For the first date, actually, before we get there, let's figure out our premium. Issue price is $648,867. Face value of the bonds is 600,000. We're trying to figure out the difference, which is our premium. Premium on bonds payable is 48,867. So those bondholders, in order to purchase the bonds, had to pay 48,867 above face value. On the issue date, which is June 30th, 2018, write a debit, skip a space, and write a credit. And on the issue date, what will we be debiting?
Bonds payable. Oh,
Debiting
sorry, cash.
cash.
Cash, sorry.
So on the issue date, we're receiving cash from the issuance of those bonds. We're going to increase cash for how much?
648,
648,
867.
867. So the amount that we debit cash for is always equal to the issue price. That's how much cash we receive. We're going to credit bonds payable, establishing the liability. And as I said payable, I wrote liability. Bonds payable is going to increase for how much?
600,000.
600,000 only, exactly equal to face value, always. We don't balance. We currently need more credits. Premium on bonds payable is a liability account. So it increases with a credit. 48,867. So if you look at the issue date for the discounted bond, the only difference here is that we would debit discount on bonds payable. When we have a premium, we have a credit to that account. That's the only difference in the journal entry portion. In our bonds payable account, it's a liability, remember, so it increases with a credit. The normal balance is a credit, so you have a beginning and ending balance on the credit side. On June 30th, we established the bonds payable account, 600,000. In our premium account, June 30th, we would have a balance of 48,867. For our amortization schedule, do you guys want a moment to write it down?
Yes, please.
Okay, so it's the same schedule as before. We have our date in the first column. Column A is our semi-annual interest payment. Column B is our semi-annual interest expense. Column C is called premium amortization, not discount amortization. That's the only difference. The calculation is still the same. Column D is our premium balance. Calculation is still the same. And column E is our bond carrying value. So I will pause the recording. Okay, so our initial date that we're going to have in our amortization schedule is always going to be our issue date. So we issued these bonds on June 30th, 2018. And when we issue bonds on the issue date, we don't owe for any interest. We're not going to pay any interest, right? So 0 is going to be our first interest payment. And the amount of interest expensed also going to be 0 because we don't incur any interest. And therefore we won't have any amortization this period. Our initial premium balance will always be equal to the difference between the issue price and face value, which is what we calculated above, 48,867. We've got like our Halloween numbers going in there, sorry. Bond carrying value is always equal initially to the issue price, right? And the issue price for a bond issued at a premium is always higher than face value. So 648,867. We know that the bond carrying value over time is slowly going to decrease towards face value for a bond issued at a premium because at maturity, we're going to pay back face value. The next date that we're going to include is 6 months later. So what's 6 months after June 30th? December 31st, 2018. Our first semi-annual interest payment date. We know that our interest paid semi-annually will be equal to 30,000. We did that calculation before, but we will need to calculate our semi-annual interest expense. So 12/31/2018 interest expense calculation is the preceding bond carrying value, 648,867, right? Our issue price here, times the market interest rate, which was 9% interest annually, times 1/2, because these bonds pay out interest twice per year. What amount of interest expense will we record this period?
$29,199.
Correct. 29,199. Interest expense is always the ugly number. It's not a pretty round number. The amount of amortization is the difference in its absolute value. We want positive numbers, the difference between the amount of interest expense we record and the amount of interest that we will pay. So what's 30,000 compared to 29,191 or 199?
801.
$801 in amortization. Our premium balance is slowly going towards 0, right? So 48,867 minus 801 gives us a new premium balance of 48,000.
66.
Yep, $66. So 48,066. Sorry for the squiggly numbers. Our bond carrying value is going to slowly decrease, 648,867 minus the premium amortization of 801, 648,066 is our new carrying value. On December 31st, 2018, we need to record that first semi-annual interest payment date. Write a debit, skip a space, and write a credit. We're going to debit interest expense. Increasing interest expense for the amount of interest that we're going to expense, $29,199 from column B. On December 31st, we're paying out interest, so we're going to credit cash for $30,000 from column A. We need more debits to balance. The difference is 801, which is from column C, and we're going to debit premium on bonds payable, reducing the premium balance. If I go up here, premium balance is reduced on December 31st. So my new premium balance becomes 48,066 balance at December 31st. Exactly what it shows in the amortization schedule. So remember, the schedule is not what's recorded in our books. We actually have to record the journal entries to get it in our books. We're going to do one more date. But is this coming back to you after you know how to do discounts? Do you feel like it's a little bit easier now?
Yeah.
Yeah.
Okay, good. That's how you're supposed to feel. For the next date, it's 6 months later, June 30th, 2019. We still pay out the same amount of interest, $30,000. You will need to do a calculation for interest expense. So June 30th, 2019. What is the preceding bond carrying value?
$648,066.
Correct, 648,066 times our market interest rate of 9% times 1/2. The amount of interest expensed is going to be slightly lower, obviously, because our carrying value is decreasing over time. So 29,163.
63.
Over time, the amount of amortization that we take will be increasing because that difference is going to be greater. So 30,000 compared to 29,163. Amortization of our premium is how much?
837.
837. Again, our premium balance is shrinking. So we're subtracting 48,066 minus 837 to get our new premium balance of 47,299.
29,
Oh, sorry, 229. I wrote it wrong.
220.
229. Bond carrying value is also decreasing towards face value. So 648,066 minus 837. Our new bond carrying value is 647
Tonight.
229, correct. The second semi-annual interest payment journal entry. So on June 30th, 2019, we're going to debit interest expense again. For 29,163 from column B. We're going to debit premium on bonds payable, reducing it for 837 from column C. And then we're going to credit cash, reducing cash for 30,000, the amount of interest that we're going to pay out. Column A. And we could keep doing this every 6 months over 15 years, but we don't need to right now because once you get the first few, you understand how to do the process. At maturity, what will the carrying value of these bonds be?
$600,000.
600,000, right? So if I want to carry this into my T account, 837 reduces my premium on bonds payable on June 30th. And then my balance at June 30th becomes 47,229. So slowly reducing my premium balance towards zero. Questions?
Yes, Professor Wei, I need help how to calculate the issue price. I'll try to do in my calculator, but I don't get the amount that you
Don't
get.
do it on the
I don't know if I
calculator.
have to do it on Excel, but I don't have the Excel
Google
program.
Google
Oh.
Sheets is free. So Google Sheets is online and it works the same as Excel.
Do I need to load that up?
No, you can just Google search it. Just do Google Sheets in Google and you'll find it.
Okay, and that way I just follow the formula that you gave us before, right?
Correct.
I'm sorry.
Yes, that's
Okay,
correct.
so we don't going to get the try to do it in calculator because we're not going to get the exact amount, right?
Yeah, I'm not going to show you how to do it on a calculator because honestly, I don't use a calculator for this. It's easier.
Okay, thank you.
Yeah. Okay, so I'm going to go to the practice problem I want you to work on.
I have a quick question.
Yes.
So at the time of issuance, it's stated that which date the interest is paid out on. Like, in the previous problem, it was so we had interest accrued, but this one we didn't since we paid at the end of the year.
Yeah, because this one was paid on December 31st, so it's all the
31st,
interest that was
okay.
incurred was paid out in the same year. In the prior one, it was paid out on January 1st, so that's why you had an accrual. Okay, so here's the premium problem again. Just do the first 3 dates. Don't worry about the rest of it. Do exactly what we just went through. They do give you the issue price. I'm not going to give you quite as much time as you had for the discounted bonds because I don't think you need it. Because now it's fresh in your mind. So go through this and complete the amortization schedule and then go through the same journal entries that they're asking you for. So I already went through and I labeled everything up above. Just compare it to what you've figured out. So they issued the bonds at 104,376. So that's the issue price. Face value of the bonds was 100,000. So what amount was our premium on bonds payable?
4,376.
Correct, 4,376. So on the issue date, January 1st, 2012, they debited cash, increasing cash for the issue price, right? 104,376. That's how much cash was received by the company. We're going to credit bonds payable, increasing our liability. For 100,000 face value, what we're going to have to pay back at maturity. We don't balance, we need more credits, and that credit is going to be to premium on bonds payable, increasing the premium balance by 4,376, the difference between the issue price and face value. In our amortization schedule, the first date is our issue date. We don't pay any interest. We don't incur any interest, right? The bonds haven't been outstanding. No amortization is taken. And our initial premium balance is equal to that credit to our premium on bonds payable, 4,376. The carrying value that we initially established on the issue date equals the issue price of 104,376. How did you do on that first date?
Good.
Good.
Awesome. For the second date, that's our first semi-annual interest payment date. And for the amount of interest that we're going to pay, the calculation is 100,000, which is face value, times 6%, which is our stated interest rate, times 1/2, because these bonds pay out interest twice per year. So every 6 months over the life of these bonds, $3,000 is going to be paid out in interest.
3,000.
So I can carry it down to January 1st, 2013 as well, because I know it's going to be 3,000 next period too. For my interest expense, we know that we have to calculate it. And on July 1st, 2012, the preceding bond carrying value is our initial issue price, which is 104,376, times our market interest rate, which was 5% annually, times 1/2, because it's paid out twice per year. So interest expensed on this date is going to be equal to 2,000.
609.
Yep, 2,609, correct. The difference between interest paid and interest expensed equals our premium amortization of $391 for this period. Our premium balance is going to be shrinking over time. So 4,376 minus the 391 gives us a new premium balance of
3,985.
Yep, 3,985. Our carrying value slowly inches towards face value. So 104,376 minus 391 gives us a new bond carrying value of 103,985. On that first interest payment date, we're going to debit interest expense, increasing that expense for the amount that we've incurred, 2,609. From column B, we're going to debit premium on bonds payable, reducing our premium for 391, column C for that amortization, and we're going to credit cash because we're paying out interest on this date for $3,000 from column A. For our second semi-annual interest payment date, we're going to pay out the interest on January 1st. We need to calculate the interest expense. So the preceding bond carrying value is now 103,985 times our market interest rate at the date of issuance, which was 5%, times 1/2. So the amount of interest expense,
2,599.
2,000.
26.
Yeah, it's going to be 2,600 rounded. And the amount of amortization is $400. The difference between interest paid and interest expense. We're going to reduce the premium balance by 400. So it now becomes 3,585. If I calculated that correctly in my head. And carrying value becomes 103,585. Okay. Since we incur the interest during 2012, but we don't pay it until 2013, there will be a slight difference in our journal entry. It's recorded on December 31st, 2012. We're going to debit interest expense. Increasing interest expense for the 6 months between July 2nd and December 31st for $2,600. And that comes from column B. We're going to debit premium on bonds payable, decreasing our premium balance for $400 from column C. And we're going to credit interest payable. Increasing the amount we owe for interest as of December 31st. And that comes from column A. In the balance sheet, what we're going to see is bonds payable of 100,000, which is face value. We're going to add in our premium on bonds payable, the balance as of December 31st, which is 3,585. So our carrying value at December 31st is 103,585. The last journal entry they're asking for is what is the entry on January 1st, 2017 when these bonds mature? Just like discounted bonds, just like bonds issued at par, the last journal entry will always be debit to bonds payable, reducing the liability for face value 100,000, and we're going to credit cash, paying back the amount that we borrowed, 100,000. We always pay back face value. Okay, I know I went fast through that. So, questions? Once you do it a few times, do you see how much quicker it becomes? Key to
Yeah.
the key for this topic is practice, practice frequently. Don't get stressed out if you calculate the issue price wrong. Honestly, it's usually just one or two numbers that you miscalculated. First thing that you need to double check is, okay, does this bond pay out interest annually, one time per year, or semi-annually, twice per year? If it pays out interest annually, get rid of the half from your calculations. So anything that we multiply times 1/2 by the market interest rate, calculating our interest payment, calculating our interest expense, get rid of those. The whole reason is because we were paying out interest twice per year. The number of payments would be equal to the term. So expect to see in your homework some annual interest payments and semi-annual interest payments. Give yourself time, practice, expect to see at least one of these on your test. So next class, we'll go over the exam prep. We'll have 2 classes for that. So you'll be prepared before your exam, but know that you're going to have this on your test, so you're prepared. Any questions? You guys ready to go?
Yeah.
Okay. Good luck. I'm sorry I had such a tough topic on this week. It's already going to be stressful for everybody. So have a great day. See you on Wednesday.
Thank you, you too. See you on
You
Wednesday,
too.
Professor Wei. Bye.
Thank you.
Thank you.
You're welcome. Have a good day.